Today we're going to talk about how to assess our performance, and we'll begin with reviewing so-called return metrics, and as usual, we begin with our short video.
Okay, so you open your investment statement, you see a big, juicy, positive number, and you feel great. I mean, who wouldn't? But what does that number actually tell you about how you're doing? As you're about to find out, that single number can hide a lot more than it reveals. So let's peel back the layers and find out what's really going on in your portfolio. Look at this, 31.53%. On the surface, wow, that's a home run. It's a fantastic result that any investor would be absolutely thrilled with. It's a number that just screams victory. Or is it just the first chapter? That right there is the central question we're tackling in this explainer. We are going to take this one number and pull it apart piece by piece to find out what's really going on underneath. All right, so our investigation begins with a real-world case study. We're going to follow a British investor's portfolio to see just how well that impressive 31% figure actually holds up under a little bit of scrutiny. So here are the basic facts of the case. The investor puts in £40,000. Over a period of time, that portfolio grows to just over £52,600. You run a quick calculation and, yep, you guessed it, the total value has increased by exactly 31.53%. So far, so good. But, and this is a big but, here's our first critical distinction. That 31.53% is just the increase in the net asset value, or NAV. It's the raw growth. That's it. A true rate of return is a totally different beast. It has to factor in how long it took to get that growth. Time is a crucial ingredient. And here we go, our first big twist on the story. When we actually account for the 504-day investment period and annualize that gain, that flashy 31.5% NAV increase suddenly transforms into a 21.96% compounded annual return. Now don't get me wrong, that's still a fantastic number, but it is a whole lot less than the number we started with. See the difference? So you see, the crucial point is that how you measure this stuff matters a lot. It's time to open up the investor's toolkit and look at the different ways you can measure performance, because trust me, each one tells a very, very different story. All right, here are two of the most important tools in the box. First, you've got the time-weighted return, or TWR. This is what you use to grade your portfolio manager, because it cleverly ignores the timing of when you put money in or take it out. But then there's the money-weighted return, or MWR. This does the exact opposite. It includes all your cash flow decisions to show you what your actual personal journey was. Now check this out. When we apply this to our case study, something fascinating happens. For the exact same portfolio, the time-weighted return is a whopping 38.67%. The manager knocked it out of the park. But the money-weighted return, the investor's actual personal experience, was 33.28%. Two completely different, yet totally valid numbers from the exact same investment. And believe it or not, there's another layer. You have to ask, are you looking at the price return, which is only tracking the change in stock prices, or are you looking at the total return, which, and this is critical, also includes all the income you get from dividends and interest payments? For the full picture, total return is what you really need to be focused on. Okay, so we've got our core metrics down pat. But, no portfolio exists in a vacuum. Now we've got to look at how these powerful outside forces, things like currency swings and taxes, can completely change your final number. And just look at how dramatic the currency effect can be. For our British investor, their return in pounds was 37%. But let's say they were an American reporting in US dollars. Well, that same performance suddenly becomes 39.5%. Or if they were European, it's 37.6%. One portfolio, three different returns. It's crazy. So what's the fix? Well, global managers use a special tool, something like a foreign exchange index, or FEI. It basically creates this blended currency-neutral benchmark. And what that does is it allows for a true apples-to-apples comparison by stripping out all those currency fluctuations so you can see the real underlying performance. And of course, we have to talk about the elephant in the room, taxes. The number you see on your statement is almost always pre-tax, but the only money you actually get to keep is what's left after taxes. And you've got to be careful. In the US, for example, there's this thing called the wash sale rule that can stop you from claiming a loss if you're not planning things out just right. So far, we've really been digging into the what, calculating that final return number. But now we get to the really juicy part, performance attribution. This is where we get to play detective and investigate the why. Why did we get this return in the first place? Now, when we benchmark our investors' performance against the market, it looks absolutely incredible. A 38.6% return just crushes both the S&P 500 and a rest of world index. I mean, this looks like a clear, undeniable, slam dunk victory. But hold on, a clear win, right? Well, maybe, because outperforming the market is one thing, but every single serious investor has to ask the next crucial question: at what cost? How much risk did you have to take on to get that return?
And here is the answer. Using a measure of volatility, we can see the investor's portfolio had a risk score of 19.8%. Now, compare that to the S&P 500 score of just 12.4%. So yes, our investor got much higher returns, but they did it by taking on significantly more risk. That changes the story, doesn't it?
And this brings us to two of the most important concepts in investing: beta and alpha. The easiest way to think about it is this. Beta is the return you get just for showing up. The market goes up, you go up. But alpha, well, alpha is the magic. It's the extra value a manager adds through pure skill. The ultimate goal, what people call true alpha, isn't just a high return. It's a high return achieved with low volatility. That is the holy grail.
All right, we have peeled back the illusion of that single number, we've opened up the investor's toolkit, and we've analyzed the hidden risk. So after all of this, what's the final verdict? What is the one thing you really need to take away from all this?
Okay, quick pop quiz to lock in one of the most important ideas here. Of all the metrics we talked about, which is the one that truly shows your personal journey as an investor? The one that includes your decisions to add or withdraw cash? Yep, you got it. It's the money-weighted return, or MWR. While that other one, the TWR, is great for grading your manager, the MWR is the one that tells your story. You know, it all really boils down to this one powerful idea. We've all heard the saying, you can't manage what you don't measure. But the real truth, the secret for smart investors, is that measurement is only powerful when you know exactly what you're measuring and why. So the next time you open that statement and see a big number staring back at you, don't just take it at face value. See the story behind it. Because understanding that story isn't just good practice, it's the beginning of your real competitive edge. Now go put that edge to work.
Okay, so let's go back to our topic today, which is return measurement, measurement, and let's think about some of the issues that we need to consider when looking at the return, and let's look at the numbers that were shown in our little video, which is, we call here, the illusion of net asset value. And the thing is that for everybody, whether professional or non-professional, a very immediate way of looking at success or failure is to compare the money you put into your account with the value of your account at today. So basically, if I invested 100 and it's now worth 130, I made 30%. So that is a very easy and probably the most widely used measure of performance. And you are happy or not, depending on whether you consider that 30% are a good return or it's just a normal return. So the first thing we really need to do is that, in fact, to convert this simple measure of the accrual or in your account into a return measure. And the usual way to do that is through calculating the compound rate of return. You can also, of course, calculate the simple rate of return, or but typically you would calculate the compound annualized return. And why annualized? Because traditional people measure things in terms of annual returns. So if you remember from your borrowing or from your deposits, you'll see that banks always announce their interest rate in annual terms, so that if you want to compare immediately with, say, your return on your deposit account, you can really need an annual rate of return. That's why people need to do this annualization of their return. However, annualization has a little bit of a, it's a bit tricky because it only works well if you annualize over a period of ideal at least more than 1 year. If you annualize for a very short period, let's say that you were going to annualize daily or even weekly or monthly returns, and if that return would be, say, 20%, if you're going to annualize it, then you get a huge return of more than 100%. And likewise, if you're going to analyze a loss of 5%, you're going to use, again, a huge return. And that's not meaningful for the simple reason that you are not going to achieve that return consistently throughout the period. So it's just one change. And if you if you take a short period, you may have all sorts of changes, and ideally you should sort of average those changes. And if you consider, of course, an average rate of return, that you can use it. Or ideally, you take the initial value, so on time zero, you go to t, and you take the compound rate, which is the rate that would give you a return to the whole period, and which is a more consistent way of measuring your return. So you have to be aware of this, and look at how it should, how you could calculate this. For instance, in this example that we're using an investment period of 504 days, which is slightly less than 2 years, and then you get here, can see immediately 3 different measures. So you have the simple increase, a fractional increase of 31%. If you use a compound annualized rate, you get 20.96. If you use just a simple annualized rate, you would get a return of 22.83. So this is, of course, would be each one of them would be a good return. But if you were looking at returns very close to zero, this could make a difference between having a positive return or a negative return, and and that would of course influence your assessment of your performance. So that's how it works. Now, but this is not yet the full story, because you also have to take into account the so-called averaging effect. So if you were, say, let's say that you were your investment you had invested 100 and it increased to 130. Fine. So you use this criteria, you have a 30% increase. But imagine that the last day you invested another 100. So you had here invested another 100. So your final value would be 230, appreciation divided by 200, right? So your end value would be 230 divided by 200. And of course, that would be a much smaller rate of return. Likewise, if you're going to have a loss, and if you make an investment just before the loss, it looks like you suddenly improved your underperformance is not so bad as it looked before that. So that's why you need always to take into account really when did you invest and when did you take out the money. So let's say you invest here, you take out the money here, for instance, and then you would take your final money if you take it here. So you have to take account the timing of doing that. So here you have two problems. One of them is that you invest in different periods of time. So you invest here, and you withdraw money here, here, and here. So you have a problem of making sure that when you compare, you compute the your rate of return, you have to take into account the timing of your investments and withdrawals. And of course, it also the other thing that you also need to take into account is the amount. So let's imagine that here you invested just 50, but here you invested 350, and here you withdraw say 20, and here you withdraw 50, and so on. So you have to take both into account the timing and the amounts invested in each period. That's why you need to have um, to consider weighted returns and not simple returns. If you're just using the simple returns, now you have to weight them, and then you have to weight them in terms of timing and in terms of money. That's why we have this so-called TWR and money weighted return. And as was explained in the presentation, we and we can show it again here in our slide. Okay, so these two measures of return, so both of them they are weighted measures. One of them weights based on time, the other one based on the amounts and the timing. So and they are used differently for managers and for investors. So investors' return is better measured through the money-weighted return, and time-weighted return is the measure usually used by managers because they are not concerned about how much money you put into account. They are just concerned by when did you put the money into your account, while you have to be concerned with both the time and the money that you put into account. So that's why. But also the reason why in practice people managers prefer to show the TWR rather than the money-weighted return is because the TWR is typically higher than the money-weighted return. So for them, their performance looks better, and that's why they usually present or prefer to present the TWR rather than the MWR rate of return. And one important thing also is that this is the return over the period that you were invested. So basically your money-weighted return is going to change along the time. So you can actually, instead of looking at your final number, and this is and why this is important, because you need to remember that the in terms of discounting, if you discount your net asset cash net asset value, basically what this means is that this is this is 0. So the money weighted return is actually equal to the internal rate of return, or if internal rate of return, which is the rate of return that would make your the present value of your return equal to 0. And if you're going to change this through time, so you're going to change this you're calculating this every day, you see, of course, that will reflect also the changes that that happened to the value of your portfolio. So the changes in NAV will be reflected here. So that's it's better if you look at a series of return and to see how it is going on, which is important, and especially when you are comparing with a benchmark, because you need to compare the same the alternative investment on a benchmark like an ETF, and so you need to look at that as well. So this is as far as one is discussing what is the right measure to use when assessing our investments. So on a daily basis, it's quite enough to know that our portfolio NAV has increased and has increased by X% on a daily basis or quarterly basis, or whatever the period we want to consider. When we want to have a proper measure, then we should use the money-weighted return. And more specifically, if we want also to be more realistic, is to consider it on a after-tax rather than a pre-tax basis. And basically what you need to do when you have your money-weighted return is to deduct both two costs. One is the fees that you may eventually pay to your broker or to your advisors, and then of course you deduct the tax. But of course you're not going to do this on a daily basis, so there's no need to do this on a daily basis. But when you do your annual review of your performance, then you should look at measures that could include both of them. And that's what you can do. Our platform provides a tool to do that, and we'll look at that, of course. But before that, let me just look at the other issues related to the return. Another important issue is just not to look at the global return, but look at individual contributors to that return, because of course the return was made up of different facts. First of all, the price change. So you have to take into account the price change and all the other costs and the incomes that your positions generated. And of course, you have to add dividends and costs and fees and so on to get what's called the total return. So basically, we have the typical the distinction is price return or total return. Total return, which is equal to the price return plus dividends minus commissions and fees, and plus an interest you earn in your account and so on. So and so this is the right measure to of your return, and then calculated, of course, through this method and deducting fees and taxes. But very often, from a management perspective, people only look at price return rather than the total return. And the reason is that these days, fewer and fewer companies pay dividends. Most companies prefer to actually buy their own stock, which is a different way of making distributions to their shareholders. And therefore, a lot of people on a daily basis prefer to look at the return, just the price return, and forget about the dividends. Of course, if you are following a strategy that is based on investing in stocks that pay high dividends, then of course you should do that, and you can do that. But if you are not following that type of strategy, you can reasonably disregard your dividends and other income and expenses, and just look at them at the end of the year. Don't worry about doing a total return monitoring on a weekly or monthly basis. You do just at the end of the year. But still, of course, it is important to know what was the source of your return, and we'll come later to talk a little more about that when we discuss the question of performance attribution in the next session. All right. So another important issue which I would like to draw your attention to, although I'm not sure if we have a slide about that here. Let me just quickly see if we have a slide about this. Okay, we actually have here. Okay, the other option, especially if you invest your other people's money, or if you are investing using a professional manager to manage your money, is a decision whether you should use your money to invest in a collective vehicle, let's say a fund, or if you invest your money in a separately managed account. So when you're calculating the return and on these two assumptions, is that you have to take into account what is your entry price, right? And if you investing in a collective scheme, in a collective pool of money, what happens is that you pay the price of a share in that collective pool of money. Let's say the collective pool of money is worth 100, and you buy 10, and then you get. You have to make sure that your share of the pool of money of 110 reflects the right cost of that pool of money. So basically, I have to take into account what is the NAV of that pool of money and the price of that pool of money. So if you are investing on a separately managed account, then your manager takes your money, invests it in a segregated account, and of course your initial amount of money is whatever money you put into the account. It's not a share of a pooled amount of money. So see, and this may eventually cause quite some difference in terms of measuring your performance. That's why nowadays quite a large number of investors are prefer to invest through segregated accounts rather than through collective vehicles. But you know, from a tax and regulatory position and so on, it depends on the protection of both types of vehicles and accounts. So you have to also to look at the safety of each vehicle. And but of course, our platform, as you may realize, is that we can actually keep a lot of segregated accounts, like I think I showed you at one stage that. So in our platform, an advisor can keep a number of accounts. So they can be monitored as separately managed accounts. But the manager can, of course, aggregate those accounts and manage those accounts as a single account. So if you want to use the same strategy for each investor, he may join all the accounts and manage that account regardless of the investors that is managing. And this is again one thing that you should be aware when you're discussing your fees with your manager, is whether you are paying for a separate strategy step run for you, or you are simply putting your money on a strategy that the manager uses for all his clients. So it's basically it's not the same as putting the money on some fund. You see, you still kept your money separately, but it's running your account as if it was part of the pool of clients that he has. In fact, he's not having the specific work of looking at your requirements, your whatever is your thoughts in terms of investment and so on. So basically, he's running it as if it was a pool of money. It was as if your money has been pooled together with other investors' money and run through the same strategy. So, of course, you have to take also that into account because, as I said, most advisors nowadays offer separate managed accounts, but in fact, they run those accounts as all the accounts as a pool of money. And it's not wrong if you agree with the strategy that he follows, because then he's using the same strategy for everyone. But if you want really a tailored strategy for your requirements, then you have to agree that with the manager and make sure that he's not following or putting your money in the strategy of all the other investors. Okay, so this is the first bit of our session. Being careful about how to measure your performance, but I forgot to mention two other important aspects that we'll resume later on. One of them is measuring your performance in different currencies, which is important, or benchmarking your portfolio against different benchmarks as well, and also adjusting your returns for risk. One of the topic that was raised in our short video, but we'll come back to those when appropriate. For the time being, I just noticed that I really forgot to mention about them.